Peter, I'm going to start with you, go to a few questions, then go to Sandy. The Bank of England stuff and these LDI, liability-driven investments, it's all new. I mean, even for market participants, it's wonky. In plain terms, can you explain to us what has happened in England and whether or not you view that as a real contagion risk for the U.S. markets?
So simplistically, pension funds in the UK, not all, but many, use this LDI that you just mentioned as a way to enhance returns in a low interest rate environment, pre what we've seen this year, in order to meet their obligations. So when we saw a sharp jump in gilt yields at the end of September, that created a lot of margin calls. They were forced sellers of gilts. The Bank of England had to come in to calm things down. So here we are a couple of weeks later. We know that Bailey said, OK, Friday is it. And based on the action in the gilts today, maybe, just maybe, we've seen enough deleveraging to put this fire out for now, as 10 and 30-year gilt yields closed unchanged on the day. As for what it means for us and other central banks, well, it's these central banks trying to extricate themselves from such extraordinary monetary policy over the last couple of years that there are going to be plenty of bumps and accidents along the road. The UK had theirs, and we're going to have ours here as well.
Why do you say that we're going to have ours here as well? What are you seeing that would make you say that with what sounds like a pretty high level of confidence, Peter?
Well, when you go a long period of time with extraordinarily low interest rates, you encourage a lot of people to borrow money. And now that you have a higher cost of capital, those that borrowed too much, those that borrowed so much where they're now have to refinance in a much higher rate environment, those are where the accidents are going to be. Also, we have to watch to see if there's any dislocations in the U.S. Treasury market. We're losing three key buyers: the Fed, banks, and foreigners. So we need other buyers. We'll find other buyers. It's just a question of what price and whether yields need to go higher in order to entice those buyers to fill that gap.
Sandy, you're a portfolio manager focused on U.S. stocks. Now you're here watching CNBC and seeing these headlines about the Bank of England and pension funds and gilts. What do you make of all this, and how has it impacted, if at all, how you manage your money? What are you watching most closely right now?
Yeah, and so, we do want to make sure that there isn't a lot of contagion. And it's interesting to see the Bank of England go from, really trying to stave off inflation to all of a sudden they're back there trying to buy bonds, which is quite a shift when they're trying to have yields go up. So we keep it in mind, but we do want to focus on U.S. stocks. We do think that we're basically the cleanest shirt in the dirty laundry. You can see what the dollar's done versus a basket of other currencies. And we're excited about a lot of our small cap domestic companies that don't have to export and things like that. And so we're dialed into the domestic companies.
Yeah. So you're not worried. I'm not going to call it a Lehman moment because that was much bigger, much more different. Maybe a mini Lehman, diet Lehman. I don't know. It doesn't sound like you're that worried about what's happening there or in Europe impacting some of your core holdings here.
Yeah, I mean, we're always trying to figure out what that black swan event could be. But if I knew it wouldn't be a black swan event, I guess. So we're definitely focused on just doing what we do best, which is just bottom up stock picking, and we're just going to keep an eye on the French, Italian bond markets to see if there's any contagion from all of this. So we just want to focus on what we do best, which is stock picking.